Breaking news on Martyn Lucas Investors channel. My name is Sensei Crypto and I'm going to be looking at a very important chart. I'm going to be looking at the US interest rate chart and what that means for the broader markets. What does it mean for the S&P 500? What does it mean for NVIDIA? This Wednesday is going to be very, very important. Join us on Wednesday. Martyn will be doing the NVIDIA day, the interest rate day. We're going to be covering the most important FOMC meeting in years. What is it going to be? Is there going to be a 0.5% cut? Is there going to be a 0.2% cut, 0.25% cut? Either way, there's going to be a cut, and we need to see what happened last time there was a cut. So let's go straight into the charts, and I'll be comparing the cuts, the US interest rate chart with the S&P 500. What does it mean that there's going to be a rate cut? What does the history say? History always rhymes. It might not repeat itself, but it definitely does rhyme. We're going to be looking at the percentage chance as well. As you can see, there's a 50% chance that there's going to be either a 0.25% cut or there's going to be a 0.5% cut. Either way, there's going to be a cut this week and we'll be covering it live. Wait until the end of the video for that link, or just tune in, type in Martyn Lucas Investor, and you'll be able to find the FOMC meeting. Hit the like button if you haven't already, and please do consider subscribing. So looking at the main chart, I've put the US interest rate on the blue color. You can see it here. Right now we're at 5.5, and in the purple we have, or the pink, we have the S&P 500. Right now you can see while interest rates have been at 5.5, the S&P 500 has continued to rise quite heavily. It has been going up in sort of a straight line, as you can see, even though interest rates are quite high. What does that mean for when interest rates come down? Okay, what was our last example? Our last example was during COVID, when we had interest rate cuts. When we had the cut in February of 2020, in March we went down to an interest rate of effectively zero, and before that we were at an interest rate of about 1.67. So let's zoom in. This chart is on the month. So last time we had a cut, it was in February of 2020, and in March we actually dropped. So even though there was a cut, the market went down in price. So we can draw an arrow. I mean, of course it is an outlier because of COVID. COVID was sort of a once-in-a-lifetime event. So let's go on to the previous rate cuts. When was that? 2008. 2008, we had when interest rates were going up and when interest rates were pretty steady, the S&P 500 was growing, maybe not as to the extreme extent that it's been growing now, but even though rates were going higher and rates were pretty about 5.2, around where we are now on interest rates, stayed there for a good few months. The S&P 500 was still going up, just like it is now. Maybe not to the same extent, but it was still growing. What happened on interest rate cuts? Of course, interest rate cuts came because they needed to. However, the markets started coming down. Last time in 2007, before the financial crash, or the beginning of the financial crash, the interest rates came down, markets came down as well. The interest rates came down in August 2007. In October 2007, we did continue going up for a little bit more. We made a slightly higher high, and then a couple months later, we crashed all the way back down, made lower lows, made we visited areas on the S&P 500 which we hadn't seen since 1997. So we went back, erased about over 10 years of growth. We actually erased that in a year. So that is something to take into consideration. Just because there was interest rate cuts, the markets continued to come down. What's the example before? Well, it takes us back to the dot-com era. Interest rates were pretty standard around 5.5%. The markets were growing and growing, sort of like what we're growing at the extent we're growing at now. There was a small interest rate cut in 98. And that actually brought the markets down, and then the interest rates continued to go higher. Markets were soaring at this point in 2000, in the 2000s, and then as soon as we had markets started coming down slightly, we got our interest rate cut in December of 2000, and the markets came down. Interest rates came down, markets came tumbling. Markets actually came down about 42% in over 2 years. So interest rates came down, markets came down. That's not what we're hoping for this time around. Let's go back to our previous example. Last time the interest rates came down. This takes us back to the era of very high interest rates. It was the norm to have quite high interest rates. And we had a period of growth when the interest rates were going up. So we can zoom in here. This is back in 1987. Interest rates were going up all the way to about 10%, and the markets were continuing to go up. As soon as we got cuts, the market initially went sideways, came a little bit down, and as soon as interest rates went below 5%, it continued going up. So this is an example of when it actually didn't matter. Interest rates came down, and the markets went up. So I think we've gone back enough in history. Out of all those examples, in 2000, interest rates came down, markets came down. 2008, interest rates came down, markets came down. In 2019, interest rates came down, markets came down for a couple months, and then went on this bull market that we're basically still in, to be honest. So everyone says interest rates come down, it means the markets continue going up. There, in my opinion, there will be a sell the news event on Wednesday. I think the markets will come down, and just because interest rates coming down, this can be the top of the S&P 500. I'm putting a warning out there. I'm not saying it's 100% confirmed. The markets look bullish. We are in a bull market. However, if at some point markets take a turn, I'm not saying I'm going to time the market exactly. Let me take away the S&P 500 because we're looking at the S&P 500. Let me show you the S&P 500 chart and tell you my thoughts on the S&P 500. So the S&P 500 has been in a bull market all the way from 2022. Parallel channel to the upside. We're actually overbought in the parallel channel. We're actually trying to hit all-time highs. It's going to be very important if we do hit all-time highs, otherwise we'll be rejected again and we might come down further. So looking at the S&P 500, it is on the verge of making all-time highs. We would like to see all-time highs because that will mean that there is going to be a change in structure. It means there's higher highs and the markets can continue go higher. I wouldn't be buying right now. The S&P is at all-time highs. If Wednesday the markets take a turn for the worst, we can look to our support level at 5,463. If that doesn't hold, our next support level is the heart line. Remember, we called it exactly on that 10% crash last time around. That will be around 5,200. If that doesn't hold, then we're looking at 4,800. And if we drop below 4,800, drop below 4,600, then we will be in a bear market. And it does look like history would repeat in terms of interest rates coming down and markets going into a bear market. So that's something to consider. If we don't want to go into bear market, if this time is going to be different, we'll make all-time highs on the S&P 500. So if you're bullish on the markets, if you want to continue making money for the next few years, what we need to see is all-time highs on the S&P 500 this week. And if it's not this week, very soon we need to see the structure continue to the upside. We don't want to keep getting rejected. We don't want to start forming big resistance at this sort of 5,600 level for the S&P 500. We've struggled to break it at the end of August. If we struggle to break it in September as well, it would form quite a large resistance around the all-time high area. And that might be the top of the market for a couple years. I don't think this will be the case, but there is a strong chance that just because interest rates come down, history might repeat, and we might go into a bear market for a few years. Just putting that thought out there. Always have plans for every situation, and one situation can be a long bear market for a few years where we go down and sideways. If you did enjoy the video, if I did open your eyes, if I did give you a different perspective, all I'm trying to do is give you a different perspective and not just feed you bullish news. There could be a bear situation with this interest rate cuts. It doesn't have to mean interest rates down. It's good for everyone. It's good for the markets. In the history, it showed that it's not been good for the markets. Until next time, do take care of yourselves and each other. Do have a look at FOMC meeting on Wednesday and have a look at this playlist down here. But yes, that is my thoughts on interest rates and the S&P 500. Until next time, take care of yourselves and each other.